Okay, folks, welcome to our weekly webinar. It's Alex here at Sestrin Capital Research. It's currently Thursday, the 26th of October. It's 5 o'clock Eastern for the benefit of the tape. Okay, so today we have a very special guest, goes by the handle of Van G7. Van runs a chat channel in the Predictive Analytic Models service, and I thought it would be a really, really interesting guest. He's an investor and trader who came to this from a normal job, a very successful normal job in nuclear engineering, and wound up giving that up in order to trade full time. Now, I'm not suggesting that this is a wise idea for everybody, but the way that Van goes about trading, I think, is really interesting. He does it successfully with humility and has got some good war stories about failing before he succeeded. So I thought he'd be a great guest to come on and talk to us about how he's been successful and how he failed first. In addition, we're going to just run through the market review. So market's obviously been tough these last couple of days. So we'll run through the 4 major equity indices. We'll do that first. We'll then go on to talk to Van. And then we'll finish off with 4 stocks reviewing earnings. We'll do Microsoft, we'll do Amazon and Intel that just reported this evening, and we'll do Meta platforms as well. Okay, as always, we run on a live and open mic basis. So any questions, comments, anything at all, best way to get those across is just turn your mic on and shout into the system. Or failing that, you can use the Growth Investor Pro chat room for those of you who are seeking Alpha Growth Investor Pro members. If you're a Substack member, one of the reasons to upgrade to Growth Investor Pro is you get live chat, which is not available in Substack. So reach out if you'd like to do that, and we can help you to make the move. Okay, let's just do our disclaimer first. So disclaimer, this webinar is intended for US recipients only, and in particular is not directed at nor intended to be relied upon by any UK recipients. Any information or analysis in the webinar is not an offer to sell or the solicitation of an offer to buy any securities. Nothing in the webinar is intended to be investment advice, and nor should it be relied upon to make investment decisions. Sestrin Capital Research, its employees, agents, or affiliates, including the presenter of this webinar or related persons, may have a position in any stocks, securities, or financial instruments referenced in the webinar. Any opinions, analyses, or probabilities expressed in the webinar are those of the presenter as of the webinar's date of transmission and are subject to change without notice. Companies referenced in the webinar or their employees or affiliates may be customers of Sestrin Capital Research. Sestrin Capital Research values both its independence and transparency and does not believe this presents a material potential conflict of interest or impacts the content of its research or publications. Okay, folks, well, let's start off by just going through the market. So let's look, first of all, at what's going on with the 10-year yield, which has been of such great import lately, and then we'll switch into the equity indices. So just one second, let's get this on your screen right now. Okay, so this is the 10-year Treasury yield, and the story here has been traded remarkably well to elite wave and fib patterns, to be honest. Previous to doing this, I didn't really know that yields would do this, but it turns out they do. So back in the COVID lows, yield is 0 to all intents and purposes, puts in a 1 up, a 2 down into the August 20 middle market. Peaks in June 22 for a wave 3 high, a 4 down, and then what you would think to be a wave 5 high here, which corresponds with the equity market lows about this time last year. And then a pretty unusual thing happens, which is the yield starts to decline. And so, as you would expect, equities go up at the same time because the risk-free rate is going down. So if you want returns, you need to take some risk, hence buy equities. But then around May of this year, the yield starts to climb. And until maybe July, it looked like it was in a downward trading channel like that. But from July onwards, it's just broken up and up and up to the upside. And that obviously has been driven by just relentless selling of US government bonds. The technical high for this wave 5, just by normal elliott wave projections, would be somewhere between the 61.8 and 78.6 extension of this wave to 1 to 3 combined, placed at the wave 4 low. And somewhat surprisingly, to me at least, we've charted this for some time in the inner circle service. It has actually hit that technical high and dropped down afterwards. Now, it looks like it's in the process of moving down. If you were to stand on your head, you could see that as a wave 1 down and a 2 up, and then we may be in a wave 3 down starting now. And that's one of the reasons I think why equities have probably started to bottom around now. Probably. Certainly bonds look like they're bottomed and are turning up. So if you, those of you who hold TLT or TMF positions, it looks like they're moving up. The Bill Ackman tweet this week I think was very well timed. Remember, Ackman isn't just a random hedge fund manager. He also sits on the New York Fed advisory board. Today, the European Central Bank said no more hikes. So I think there's let's call it a fact pattern or a opinion pattern that says maybe yields have peaked and maybe yields are going to come down. And if yields come down, we'll probably see risk assets, equities rise. And with that, let's take a look at the 4 major equity indices. So let's just keep it zoomed out. I mean, if you zoom in, it's really easy to freak out on a day like today, but let's just zoom out. Okay, so this is the S&P. This is the wave 4 low in the larger degree of the cycle that began 2015-2016, and this is October last year, around a year ago. And so around a year ago, we're at 350, and now bottomed out at around 410 today and bounced a little bit after, towards the close. So at this level of abstraction, that still looks like an up market to me. Now, if we're going to zoom in, and if we were to use the ES futures as a proxy, then the problem in the short term is this drop down yesterday. So I'm sorry, today, which is this 4,200 level on the futures is important. And the reason it's important is because that was a wave 1 high that was struck in February this year. Normally, you wouldn't expect to see a wave 4 drop much below the wave 1 high. Now, if we get a rebound now, that's okay. That's still consistent with this technical pattern that's worked so well all year. But if you get a real drop now, then something different is going on. We need to take another look. But for now, I would be looking upwards in the S&P. NASDAQ, let's take a look. Large degree first. That's our bull case. Let's ignore that for now. That's our base case on the NASDAQ. This is the QQQ ETF. And this is the wave 4 low. Last October, a year ago. So this time around a year ago, it was at 254. Now at 344. So it's clearly a huge run up for the NASDAQ this year, even though everyone's feeling all miserable now. And again, at this level of abstraction, you would say, no problem, that's a rising market. If you were to zoom in, and let's look at the NQ futures to do that, then again, you see the problem, which is this 5-wave pattern that started back in December last year. Wave 3 high here in July, pretty relentless wave 4 down. That's now the wave 4 down low. So we're at a and squealing if that happened. So right now, I think the Nasdaq still looks very bullish, but clearly people are, feeling fear about it. If we were to reset the likely wave 5 termination zone for that lower wave 4 low, that's what it looks like. So in both the S&P and the Nasdaq, if you zoom out, no worries, right? Market's moving up. If you zoom in, you can see what all the pain and stress is about. Now, as always, unless you're trading very short term, and some do, but most don't, then it's usually best to zoom out. Don't get lost in the tweets and the CNBC stuff. focus on the higher level. Let's look at the Dow. This is the DIA ETF. This has been stronger than the NASDAQ and the S&P in the last few days. Again, at this level of abstraction, wave 4 low back in September last year. It was the first one to bounce out. Again, you'd say that's a moving up market. Zoom in, look at the YM futures. And what we have here is, we've seen this in the S&P actually, 1, 2, 3, 4, 5 waves down, not 3 waves down, but 5 waves down. The S&P just did something very similar. So we just recast that as follows. Something like that. So again, you know, that looks like it's going to terminate soon. You know, that 5's now passed beyond that wave 3 trough, and so you would expect that to start to turn around. Some of the Dow stocks are starting to do really well. Intel, which is a Dow stock, reported tonight, great results. Some of the financials, which are in the Russell, we'll talk about in a moment, are reporting good earnings. Visa is not a Russell stock, but it's financial sector, which is a lot of that in the Russell. Great earnings this week. So the fundamentals, we're going to come to that in a moment, are looking pretty good now. But these sell-offs in the indices in particular are, you know, option market driven, fund driven. They're technically driven sales. And if you look at the fundamentals of the market leading companies that are being printed right now, they're pretty good. So if you have the yield coming down, fundamentals looking good, feels like a turnaround is about to happen. And so, as you know, we remain bullish in the service, remain looking upwards, and that's why it's not just, you know, a refusal to see what's on the screen. It's, if you look at actually what's going on, if you zoom out a bit, plenty of reasons to be bullish. Number one, the yield, and number two, fundamental performance of the big stocks. Let's just finish off by looking at the Russell. It's the IWM, closed up a little bit today. And you can see it's right down here at this resistance level, support level, I should say, I'm sorry. And up today, this is a weekly chart, quarter of a point up today. Probably this turns around now. Again, yield down. This is very sensitive to the yield. Financial stocks starting to do better. Lots of financials in here. And again, if you look at the Russell futures up today, this here, this ABC correction here, this is a really long C wave, or 1.618 extension of this wave A, which is a not atypical wave C correction. So again, a good chance this starts to turn around pretty soon. So in short, you know, if you turn on Twitter, if you turn on the TV, if you read the financial press, there's a huge ton of negativity. But if you zoom out, first of all, the charts at a certain level of abstraction continue to look bullish. And secondly, if that yield's falling and company results are looking pretty good, there's no logical reason why stocks should continue to fall. I would expect to see some turnaround pretty soon. Okay, so that's a quick index review. Now, I want to hand over to Van. I'm going to put him as a presenter right now, and I'm going to ask Van to introduce himself and talk to everyone about how he got into investing and trading, and then his investing and trading story, what he did badly and what he's been doing really well now. Okay, Van, I'm going to make you a presenter just now.
Okay, can you hear me?
We can hear you. No one can see your screen yet, but they should be able to in a moment.
Okay. Do you want me to share my screen now? Or?
If it gives you the option, yes, please. Here we go.
I don't think I can share my screen.
Okay. How's now?
Okay.
Yep, we see it.
Okay. So let me introduce something about myself. I'm Van. Okay. And before I'm a nuclear engineer, like you said. I'm worked in my in the nuclear for quite 10 years, and after that I found that I don't have much passions for this career, and then after that I changed into my trading career. but before I know something about trading before during my my work, and
Hey,
I started to
Van, it's
learn.
Alex. Van, can
Yes.
you shout? It's hard to hear you. Could you just shout or move closer to the mic?
Uh, you don't hear me clearly?
Hear you okay, but it fades out sometimes. So if you can just speak up.
Okay. Okay, let me try. Okay, I can speak slowly so that it is clear for you to hear me. Okay.
That's great. Yeah, thank you.
Okay. So maybe I started trading at the beginning of the 2010, sometime around that. I don't remember well, but I remember that I burned my first account. My parents is about 50K or 70K, 70,000 dollars for a few months. So that's my first fail in my trading. I remember well. At that time, I don't have any knowledge about the trading. I just trade based my instinct, and I think that I can move the market. I think that is go down, up, go down, and something like that. And at the end, after 1 month, is on fail. That's my first experience in trading. So after that, I started to look in some video on YouTube, and I learned something, but it didn't help me much. And after that, I continued to burn my account two, three, four times more. And but luckily, I don't make it difficult for me to trade because uh, every time when I started to trade, I I said to myself that. Uh, that is the money that I can get rid of when I fail, and I don't make it. I don't make it bother my life, my work. So it's easy for me when I fail like that. But after that, uh, until 2020, when the COVID happened, there's something in my life. I think that at that time how can I say I started I think that I make a decision of my life. I I demission. I asked and my company that I stop working, and I want to go on my own for 100% trading, a full-time trading like that.
So
And
Van, it's Alex. So
yes,
that is a huge decision, right? So at this
yes,
point, so you're in nuclear engineering,
yeah.
and you've been trading for 10 years.
Not totally 10 years because each time when I fail, I need to stop 2 3 years to pay my due because I borrow money from the bank each time to trade, and I think that I can pay for the bank each time 2 3 years. After 2 3 years, and I restart to trade.
Okay, so
So
you blew up three accounts, and
yeah.
how many years before you got good at it?
Um, for example, I first trade in 2020, in 2010, and after that I returned maybe 2014, and after that 2017, and after that 2020. So each
Okay,
time I return at the time like that.
okay. So
And
what when so
yes,
why did you what made you think, well, I'm going to trade full time now? What was it that gave you the
yeah.
confidence to do that?
Yeah. So in 2020, when I first trade with the index future, because before I trade only with stock, and in 2020 I trade with the index. First time I changed because I make a huge mistake with the stock trading. So I decided at the same time at that time to trade into to index future for the trade, and I have the luck because when I started to trade index future, is the top of the market, and after a few days, it started to fall, and I earned a huge money at that time. But I cannot keep that money during the fall of the COVID, and after that, I burned the last account, and I stopped trading for a while, and I started to think why I always earn much money at the beginning, and after that I cannot keep it, and I synthesized all my trading experience and all my mistake, and I started to build my method uh, based on some indicator, some price action, and I started to backtest this during for 5 or 6 months.
Hmm.
And during this 5 or 6 months like that, I can keep the money. Uh, with the money I can earn during the 5 6 months like that, and I can keep that at the end of the test. And I think that's it is work, and I make a huge decision at that time because I don't have much money, and I resign. I demand my enterprise to stop working, and luckily they can compensate me for them, like 10,000 euros, and I use that money to the trading account. And at the end of that year, 2021, I can earn about 20,000 euros for 3 or 5 months. Okay. So
So when you did,
uh,
when when
yes.
you when you sat down to say, well, every time I do this, I make money and
Mhm.
then I lose it all again.
Yeah.
What were the 2 or 3 lessons that you concluded? What did you decide was going wrong?
Yeah, yeah. Some lesson that I can retain from my experience 5 years is that uh, although the method is very effective, that I can show you after. But there's something that you cannot keep the profit because, for example, the psychology, for example, the greediness, and also the ego of the human. Because when you start a position in trading, the problem is that you can keep it as long as possible to make the huge profit. But if the psychology can make you do it, sometimes you quit very early, and you cannot make the big profit. And sometimes you keep the loss long enough, and you burn your account.
And
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 if you don't have the proper method, you cannot do it well.
yeah. And so what then did you start to do differently? Because you've been successful since then. And the thing that caught my eye about the channel you run is, your
Yeah,
multiple
yeah,
20 to
yeah,
100K runs. And the thing I thought was
yeah,
really interesting is it's really good
yeah, yeah,
evidence of how, um, you don't have to have, hedge fund manager type amounts of money. And you don't have to be a trained hedge fund investor to do really,
mhm,
really well if you're skillful and you're
mhm.
focused. And
Yeah,
so, what I liked
uh,
about your experience is, one, you weren't just lucky, so you messed up a few times and you learned some things. Two,
yeah,
you then put that into practice and you turned, losing behavior into winning behavior. So I'm really
yeah,
interested in, okay, so you said I kept losing because I just didn't have the right psychology, and my ego would get in the way. So I would either fail to maximize my profits, or I'd watch all my profits turn into losses, and I just wasn't doing it right. So I decided, I now have a system. I can do this right, and since then, for the last 3 years, you've been really successful. So
yeah,
what's different now? What's different about your psychology or ego or system? What's different now?
yeah. Yeah, my system is always the same, but there's something I add into my system is that the hedging.
The hedging.
That's the important thing. Yeah,
Yeah.
That's the most important when I find out on Twitter with Robert Bannon, because in 2021, 2022, at the beginning, I still earn a lot, but I don't know about the hedging at the moment, so I lose a lot also.
Mm-hmm.
Although I always keep my account floatable. So after that, and when I find by chance on Twitter about Robert Ballen about the hedging, and I started to subscribe into his channel Palm, and I can say that it's Eureka at the moment, because I think that with my method and with the hedging is the nice combination. It's a nice combo that I can lose anymore.
So
But
basically, you learn to use hedging so that when the market or
yeah,
the index or the particular instrument went against you, you could
yeah,
put a pin in. You basically could pin your account at that point,
yeah,
and just
we,
suspend time if you like. So you're showing a paper profit. It starts to go against you. You hedge that position and you wait, cash out the hedge, and
yeah.
then resume the original direction.
Yeah, there's something about the hedge. Hedging is only one part of my system. There's something about that also, because before with my method, with my system, not hedging, so I need to wait. I need to wait the signal to enter a trade or to get out of trade with the signal. But with hedging, I can enter the trade any moment. I don't need the confirmations. I just enter the trade. For example, I can share here for with my screen. For
That'd
example,
be great. Thank you.
yeah. Can you see my screen?
Yes.
Yeah. Here's the Nasdaq. So I draw a channel here for at the beginning of the July, since July when we had the corrections until now. Okay.
Mm-hmm.
Here,
Yep.
this is the main channel of the Nasdaq, and you can see well that when I first the first channel we have is like the violet, the pink channels like that. Okay.
Mm-hmm.
And with the time we develop in the bigger channel, so you can see here, and maybe we can bottom today when it touch at the lower channel. So for example, when I where at first when I have this the pink channel like that, when I had the signal is here, okay, I can short the market until it reach here. Okay. And when the price reach here, so either I can get out my short, for example 50% here, or I can hedge 50% by buying the market here. Okay.
Mm-hmm.
So without hedging here, I must get out of the market, maybe completely or maybe 50%, I don't know. But it give you much more pressure when the price reach here. You don't know whether the price continue to go down or it will bounce from here. Okay.
Mm-hmm.
So
Yep.
with the hedging, I can buy the market here, and I don't care if it continue to go down or it reverse up. So it reduced much more pressure for me with the hedging, and it can help me to keep the positions as long as possible with the hedging. So that's the first thing that I can admit, that the hedging is very effective in reducing the pressure for the psychology, for the emotions. And that's the thing that I admit, I like very much with the palm method, the hedging. Yeah,
So basically, if you, unless you're at major market turns, if you
mm,
own a long and a short position in the Nasdaq, let's say, there's a good
yeah,
chance that if you're patient, you get to make money on both sides, right? So
yeah,
if you buy, if you go heavily short at the October 22 low, good luck with that. But at
yeah.
most points in a market cycle, you know, it just takes patience to make money from the long and the short as well, in my experience.
that's one part of the method because besides of the hedging, besides of the system, you need to manage also the position. I mean that the part, the how can you divide your capital into your positions? How much of your position, how much of your capital you invest in each position? I mean, for example, if you have a 100k account, so if you start a position here, how much do you use it? That's the
Yep.
question. Because if
Yep.
you use too much and after that the market goes against you, how can you hedge? So that's the part of my system also.
So point one is use hedging. Point two, minimum. Don't over trade. Basically,
Yeah,
don't use too much capital.
yeah.
Yeah.
But when you define the trend, after that you can add as many as possible in your position to profit the trends, the tendencies. I mean.
Hmm.
So that's why there's something in Palm asked me about my trading style. I mean, and I say that I'm very aggressive trading trader because at the beginning maybe I start with a small position, but after that when I define the trend and I will add as much as possible to the trend to the positions in order to profit as much as possible.
Yeah. Very good. And how many different instruments do you trade? Right. So in my experience, it's hard to watch if you're trading real
Mhm.
time. It's hard to watch lots of different things at a time. So a couple of the equity indices, bonds, maybe it's hard to trade 10 things. So how many things do you trade?
I don't use many indicator. I don't use many other system. I only use the price actions here, as you see the price actions, the channel, and the Fibonacci to decide the point where I can get out, or where the point where I can get out or get in the trend.
Yeah.
So only the channel, the price actions, and Fibonacci that I look in order to trade. I
Yeah.
don't want to complicate it, my system, because as many indicators as you see, and that will complicate it, your decision.
That's right. Yeah, it's very easy. I mean, because there's so much data available and so many different systems and indicators, I think it's really easy to chase around looking for one and then another. And my experience is the best thing is find one that works for you. Find a simple set that
Yeah,
works for you and stick to it.
yeah,
Because all these different indicators and measures, they're all describing the same thing.
yeah,
Um, they're just using different windows on the same thing. And trying to use 5 or 10 different systems, in my experience, just dilutes the focus. And finding a system that works for you is the key, I think.
yeah. So that's the right thing that I want to keep it as simple as possible. So when I look into the screen, I only trade with the 1 hour candle, for example.
Yep.
But when I want to draw the channel or the prices like that, I only use the 4 hour or 1 day to to draw all the things like that important. And after that, I zoom it out into the 1 hour candle, and after that, I can trade it easily.
So you basically zoom out to get some longer term perspective and zoom in for each
Yeah,
individual trade. Yeah.
yeah.
And so your decision to stop, a real job and just trade for a living, that's worked for you for 3 years now, is that right?
Uh, I started in at the end of no, it 2 years. It two
2 years.
years. Yeah, because I begin at the 1st October 2021.
Something else that you do that I think is really smart, and I don't think many people do this is start with an amount in an account, um,
Hmm.
set a target, trade
Yeah,
until you have that amount, and then take the money and do something else with it. So in other words,
Yeah, that's what I do because when I had the huge profits, and after that I withdraw some and invest in another domain. For example, the real estate. You
yeah,
can buy something for family to like something like that, and you can pay you at the end of the month also, like you are a worker, like you are a
yeah,
finance worker, for example.
yeah. So in other words, rather than just letting your account, balloon to large numbers, whereupon it might make you feel good, but the risk just keeps going up. You've said,
Yeah.
well, I'm going to run it up to a certain level, and then I'm going to withdraw some funds, and then I'm going to run it up again, and then withdraw some
Yes.
funds. I think it's a
Yes.
really good method of risk management that I don't think many people do, because everyone wants to be a genius, right? And everyone wants to
Yeah.
achieve compounding and all those things. But in actual fact, if you do compound your account successfully, then because the number looks big, I think it's easy for ego to overcome one's decision making. I think it's really
Yeah.
smart to say, I'm taking some money out and I'm going to go again now.
Yeah, because I have the experience for a bigger account also. Because in 2022, I had a bigger profit, like 600,000, and after that, the egos the bigger. And if you can manage your ego and your greediness at that time, you can lose very quickly because when you trade with a large account, it's very easy to lose all the money.
Yeah, I agreed. Hey, Van, I have a question from one of our members, Jay, who says, can you explain how you adjust your hedging ratios? So if you look at the channel you've got there,
Mhm.
so let's say you've taken a long position to begin with, you add a short, do you just hedge one to one and then release the hedge, or do you change the ratios, or what do you do?
Yeah. Okay, so take one example from here. For example, when have the signal to short the market here, for example, you have the three touch. For example, I short here at the third time. Okay, and when the price goes down, you can add your short position. So I don't know how many short position do you have, but at the end of the trend now, when it touch down here, at least you can secure at least 50% of your short position.
Yeah,
So either you get out 50% of your short position here, or you will enter 50% like hedge long hedge from here. Okay,
yeah,
so that's the first when you manage your hedging position, and after that, for example, I take an example here. I will add my 50% hedge long hedge, okay, and here the market bounce. So when I draw the Fibonacci from here to here, we will see that it's bound here lies 50%. So either here you can release on your long hedge, okay,
yeah, understood.
and you keep your short here, and
Yeah,
if the market continue to go up, and after that you must decide the position, for example at 61.8 plus 50 to hedge your short position. That means if the market go up from here, you choose your Fibonacci 61.8 plus 50 points for Nasdaq, and after that you can hedge long again 50% as you wish. And after that, when it's past here, for example, is you can hedge 100% from here. That's that's
so
that's
so,
an
so one.
example only.
Okay, so you're looking for bounces measured as 61.8 retraces, basically.
Yeah,
Yeah.
at least 61.8 plus 50 points to hedge at least 50% your position.
Okay, understood.
Because to me 50% is always important for the long term, and when
Yeah,
I can take the profit for the 50% in the long term, you always win.
yeah, understood. Terrific, thank you. And so I'm going to stop you there, Van. I think that the approach you take is incredibly sensible,
Mhm,
not glamorous, right? Not
mhm.
not high ego, not showy. But I know because I've watched you, it works really, really well.
Yeah.
Anyone who wants to follow Van, he posts live in a chat channel in the predictive analytic model service. You know here that we're fans of Pam. Anyone who wants to sign up over at PAM, you get a third discount as a Cestrium member. We don't get a commission or anything like that, but there's good synergies between what they do and what we do. They run a much shorter term focus. And if you do sign up for PAM, and I'll send a link around later, do head to Van's channel. It's called van.g7, and you'll see him post live throughout the day the trades that he's running. And again, the thing that I've been impressed with is two things. One, trades completely without ego, completely without a view that he has to be right. But what he's done many times, because I've watched him do it, is start an account with a small amount of money, 20,000 euros, turn it into 100, withdraw the money, start again, 20 to 100, withdraw the money, start again. And again, what really caught my eye is here's someone who is not a trained hedge fund trader, not someone that's all over Twitter telling everyone how great he is, but who is consistently making money. And I was more impressed after I spoke to Van and said, well, how did you get to do this? And his answer was, I messed up first, because that's always the best training. So I want to thank Van for attending today. Thanks ever so much for talking to us, and we'll send folks over to your channel if they're members already at PAM, as many of our subscribers here are. For anyone that chooses to join, do see the van.g7 channel at PAM. Van, thanks so much. I'm going to take the screen back.
Okay, thank you, Alex, for inviting me for the.
Not at all. Great job. Thank you very much.
Thank you. Bye bye.
Bye. Okay, thanks again to Van. I'm going to switch the screen back to myself now, and let's go through some earnings just now. So, okay. So let's look at Intel that reported today after the bell. Let me just see if you can see that. Okay, yeah, I'm just going to zoom in just here. So Intel, as you will know, is in the middle of a corporate turnaround. The company has been on the wrong track for quite a long time, a decade or more, I would say, of mismanagement, ceding various key technical points to competitors. So a long time ago, they missed mobile. That's why ARM is even a thing today, because Intel missed the opportunity. They missed GPU, which is why NVIDIA is a thing. They've ceded a fair old bit of market share in CPU to AMD that previously was, a nothing burger in terms of market share. And more recently, in 2017, 2018, they made some big missteps in their manufacturing operations. So one of the things that marked Intel out was that they actually made their own devices. They were a so-called integrated device manufacturer, both design and manufacturer. There's not so many of those around now. Between them and TSMC, they are the globally dominant manufacturer of semiconductors. And what's important in semiconductor is two things. One, that you can manufacture at smaller and smaller so-called process node or feature size. You'll see it called different things, but basically you can keep on making smaller and smaller chips. Secondly, you can do so at high yield. In other words, the number of functioning semiconductor chips that you get off each wafer of silicon has to be very high, because that's how you make your margin. And Intel messed up as process nodes shrank. They really did not keep pace with TSMC. And so not only did their own brand devices start to lose share in the market, but their manufacturing prowess also started to fail. Now, recently they've hired a new CEO, Pat Gelsinger, and the company has started to turn around, and it's not done yet, but the progress that the company's making is pretty remarkable at the moment. The numbers still look pretty ugly on the bottom line. If you look at the cash flow I'll go through in a moment, it's still pretty awful, but that's because the company's in the process of building a series of new fabrication plants, fabs they'll call factories in normal speak, in various places across the globe. And the reason they're doing that is because the US is in essence sponsoring Intel to assist with the reshoring of semiconductor manufacture back to the US. So you can consider this to be a trade war artifact between the US and China. Quarter just printed was a really, really good quarter. And it's not one to get excited about from a high growth perspective, but if you just look at the revenue trajectory of late, let's start at the December 21 quarter. So $20 billion of revenue, 3% growth on the prior year. And then just look at the growth rates. Right? So it just plunges down to negative 36% in Q1 this year. So, revenue in Q1 of 2023 is pretty much half what it was in December of 2021. And as you know, from the semiconductor industry, that's not normal or good. The company puts a bottom into its growth rate in Q1 this year. So Q2, we had a negative 15% growth, and it's in green here because it's getting better, as in less bad. Negative 8% this quarter. And the guidance for next quarter, if you look, is for the company to actually grow for the first time in what will be 2 years if that happens. Guidance so far has been pretty good in the last couple of quarters, so it was a big beat this quarter. So I'd be very surprised if they were to miss next quarter. And if they hit quarter-on-quarter growth, then 2 or 3 quarters after that at those kind of rates, then they should be back to flat revenue and then growth thereafter. Now this, NVIDIA a year ago had flat revenue. It's hard to believe now, but it did. And so, semiconductor companies do go through this from time to time, but they have to recover from it. And Intel's challenge has been on just being outpaced in their choice of devices that they chose to make, and again, outpaced in manufacturing. Let's look at gross margin. A big improvement this quarter, 39%. Now, in the past, it's been in the high 50s. TSMC is in the high 50s. But look, it plunged 34% in Q1 this year. They're guiding next quarter. They guide on gross margin, Intel, and usually 43% guide next quarter, which is that will be the best it's been since September 22, and stepping up towards where it should be, which is 50% plus. Operating income, the company's going through some pretty heavy restructuring charges. So there was $820 million of restructuring charges this quarter, and operating income was basically flat after those charges. So about 800 million, of operating income before the restructuring charge. If you look on an EBITDA basis, then it's still coming down. So at least on a TTM basis, but it's starting to move up on a quarterly basis. So we had $2.8 billion EBITDA. Again, that's after restructuring charges. Strictly speaking, for EBITDA, you could add restructuring back, but we kept it conservative there. And trailing 12 months, just under $7 billion now. Now, the problem is on cash flow has been that cash flow happens below operating income, below EBITDA. And so all these numbers are kind of meaningless when you're spending huge numbers. The last 12 months, CapEx has been in excess of $21 billion. CapEx, has been in excess of $21 billion, and that's basically factory construction. And so you can have all the EBITDA in the world if you're spending a lot of money on CapEx, and you're still going to have negative cash flow. But again, cash flow is getting less negative now. So unlevered pre-tax free cash flow now, which is EBITDA minus CapEx, minus change in working capital, about $1.3 billion negative. But remember, 800 was restructuring. So it was almost break even if you ignore the one-time restructuring charges. Restructuring only happens once. Those fees the costs you hit are not going to recur next quarter, which is why you can sometimes see it added back. Cash flow margins troughed on a trading 12-month basis back in Q1 at negative 49%. That's pretty incredible. Now at negative 47%, so it's just starting to climb up. Quarterly basis minus 31. Now the only reason it can do this, frankly, is because the company in essence is a national champion. Its balance sheet's okay. It's not too levered, so it's 2.7 times trading 12 months EBITDA. But again, with negative cash flow, there isn't any money available for debt service except for money they've already have in the bank because they're not generating any cash. So that's not something that if you ran a normal business you could sustain for very long. But if you called Intel now, just as if you were called Boeing a couple of years ago, you can do that because that's the national champion status. That's what it gets you. The stock was up in after hours trading. Let me just see where it's got to just now. Okay, 35. Yeah, it's held up. It's actually moved up again. So really nice move up. $35 up, so 6-7 points up. And if you look at the valuation at the moment, that the numbers aren't huge, but you have to bear in mind the trajectory. So 3 times revenue at this point in time, I don't think is a bad price. Growth is, you can argue that growth is negative, but growth is about to swing positive on a probably next quarter, and TTM positive within maybe 3 quarters. EBITDA, 25 times EBITDA, okay, interesting, but again, it doesn't turn into cash flow at the moment, so the cash flow multiple doesn't make any sense. So I think you have to step back and say, well, at a reasonable run rate of EBITDA and cash flow margin that a business like this should make, is 3 times revenue an outrageous price? I don't think it is. I think it's very viable. On the chart, we have Intel as an accumulate opportunity between, I think, 24 and 34, if I recall correctly. So the stock's just moved back into our markup zone. We'll switch the rating to hold later on. But a really, really good quarter, and I think another step in the right direction for the Intel turnaround. Okay, so it's up seven points now on a pretty grim day, so that's a good go. Let's look at Microsoft that reported this week. Everything at Microsoft is just fantastic this quarter. Let's zoom in a little bit. So revenue growth, 13% year on year this quarter. Now, this is a business that has $218 billion of revenue in the last 12 months. And it grew this quarter at 13% and trailing 12 months at 8%. That's pretty remarkable to move that much revenue up that quickly, in my opinion. Gross margins at, I think, an all-time high, or certainly a recent all-time high of 71%. EBITDA margins, 54%. Also, if not an all-time high, then certainly a recent high. Cash flow margins heading back up towards all-time highs, 39% now. So this thing is on fire. This is what, not just what good looks like, but what superb looks like, especially for a company of this size. $84 billion of net cash. That's before the Activision deal completes, so if that's a cash purchase, that will go down. And then if you look at the order book, remaining performance obligation, they have about 1 times the last 12 months revenue booked already for future orders, about a half of which is due to be recognized in the next 12 months. And what that means is you have a fairly relaxing ride. You're not hoping that you make X revenue or Y revenue next week. You're pretty sure you're going to make it, which means the company's proclivity to miss its earnings is just lower than the average company. So this is a superb set of fundamentals. It's a huge business. It's growing quickly. It has huge margins, great forward visibility, and what's it trading at right now? Dropped off a bit today, down about 3 points today. Okay, $327. UBS has to pay 20 times EBITDA, 28 times cash flow, 10 times sales. Again, I don't think that's expensive personally. So that's Microsoft. Let's do Amazon that printed today after close. We don't cover Amazon, but I hold a little bit of Amazon stock, and we write public articles on it in Seeking Alpha sometimes. It's a great quarter. I know the stock sold off. It was up to begin with, sold off afterwards, but the quarter was really good on fundamentals. Look, growth rate accelerated. So 9% growth in Q4 last year, 9% in Q1, 11 in Q2, 13 in Q3. TTM growth, 10% now. Guide for next quarter is that TTM picks up to 11%, even on the 10% guide for the quarter they've put down, which I'll be surprised if they don't beat. Gross margin, 17%. Remember, Amazon, this includes all the retail business, and so it's inevitably a low gross margin business. AWS, much higher margin, of course. EBITDA margins up to 18% now. That's the highest for quite some time. I don't know if it's an all-time high, but certainly the highest in 5 years. Cash flow margins, 5% now, which is the highest since the March 21 quarter. Balance sheet, back into a net cash position. It's been in the net debt position for a little while with big capex. Net cash now, $3 billion. And then valuation, let's just see where the stock is. 124. Okay, it's back up now. So, okay, it's sold off. It's gone back positive now. So 124. The revenue multiple is low for these things because of the poor margins. But if you think 13 times EBITDA, not particularly expensive. Cash flow multiple, I expect it looks big, but I would expect these cash flow margins to be coming up now. If you look back 3-4 years ago, they had basically double the margins because the capex wasn't as big. What you'll see at the moment with all of these cloud businesses, Microsoft's the same, is heavy capex investment in data center, and that's basically a generational refresh in data center. You'll see it called AI, but it's a generational upgrade. So normally you would expect to see Amazon doing 8-9% cash flow margins, which would obviously cut that cash flow multiple there somewhat. If you look at the chart for Amazon, then this is a monthly chart. Now, that looks to me like a generally trending up chart. This is a peak back in 21. This is right around the time that Bezos stepped down. The low hits, like everything else in tech, November 22. Big move up this year, a little bit of a sell-off, but that's a big improvement in operations. Really good quarter. So we'll see what happens with the stock. But if the market turns around, I would expect it to be able to lift Amazon quite nicely. Let's do Meta Platforms, which printed yesterday. Fantastic quarter from Meta. Everywhere you look at the moment, there's talk of recession. If Microsoft is growing like that, if Amazon is growing like that, if Meta is growing like that, I'm not sure why anyone thinks there's going to be a recession. So this is Meta Platforms. Remember, where does the revenue come from? It comes from advertising. When do people advertise more? Answer: when they're confident of return on it, when they think the economy is good. So look at the growth trajectory that Meta went through. Peak growth, June 21, 56%, and then it started to fall and went negative briefly. September 22 quarter, -2, December 22 quarter, -4, turns positive in Q1 this year, 3, 11, 23. Look at the acceleration, it's huge. The guide for next quarter is 19%, quarter on the prior year quarter, and if they hit that, they'll take TTM revenue growth of 14%. It's at 7 right now. Gross margin, recent high, 82%. EBITDA margin 48%. There's still a lot of OPEX spending going on at Meta Platforms. Investment in Reality Labs, that's their AR, VR, metaverse business, and a whole bunch of other things. Again, data center upgrade, that hits CapEx mainly, but that does also need more people. CapEx remains really heavy. You'll remember they were absolutely dragged over the hot coals for the metaverse CapEx spending. Well, they've let up a bit, so it peaked at $9 billion for the December quarter last year, but we're still at $6.5 billion. That's still some pretty major investing, and that ought to benefit people like NVIDIA, Intel, AMD, and so on, because much of that is going to be going into systems hardware. Cash flow margin is now at 31%, so climbing up nicely. They bottomed out at 20% in the December 22 quarter. It's progressed 19, 24, 31, so you can see moving in the right direction. And the company gets $43 billion in net cash, so absolutely as safe as houses. And then we come to the valuation, which is cheap in my opinion. So let's check the stock price at the moment, 287. Okay, so you're being asked to pay 5.5 times revenue, 11.5 times EBITDA, 17.8 times cash flow. And you'll pay more than that for Raytheon or Northrop Grumman or Lockheed Martin, any other number of ex-growth defense contractors that might pay you a bit of a dividend, might do a buyback, but they surely don't have the growth stock characteristics on the upside that Meta Platforms does. So this looks cheap. Now, Meta bottomed at 7.5 times cash flow about a year ago, and I remember nobody wanted to buy it. And I remember saying at the time, we published publicly on Seeking Alpha saying that's a screaming buy, and it's just done brilliantly this year. Personally, I sold out from my Meta position earlier in the year just to take some profits. I think that the stock can participate really well in any market recovery that happens right now. It's a great quarter. Finally, let's just look at Meta stock. Now, it's a great chart, this chart starts at this is a monthly chart, starts at the post-IPO lows. Those of you who are old like me will remember the Facebook IPO. It was a bungled IPO. It wasn't handled well. The stock dumped afterwards. There were problems with early trading. There were problems with the underwriters. All manner of things went wrong. And then pretty much as soon as they went public, mobile started to really take off in the US. And they weren't prepared at all. They weren't really on mobile. They hadn't built it for mobile. And they had some real problems with advertisers. So it was a bungled IPO, frankly. So this chart starts from the post-IPO low in the middle of 2012. And the stock runs up pretty effortlessly, really, you know, some bumps in the road in 2018 and again in 2020, of course, but runs up from 21 to $387 in the space of 2012, about 8.5 years, but 9 years. And then it drops 78.6% or thereabouts of that value from July 21 to September 22. So in about 15 months, it loses 80% of the value. It took 9 years to gain. Well, that, ladies and gentlemen, is what a wave 2 looks like. And so I remember we were writing at the time saying, you know, Zuckerberg's unlikely to take that lying down. Guy's a winner. You might like him or not like him, but he's a winner and he'll turn that around. And he did. And look on the monthly chart. So from October 22, it didn't have one red candle until July this year. And so that's been a big run up. We've had this at accumulate between 100 and about 150, if I recall. Yep. And it's just run up really nicely ever since. So I think what comes next probably depends on market direction. If, as I suspect, we see another leg up in the market, it's probably not a bad time to be buying meta platforms. Risk reward obviously isn't as good as down here, but I think if you look at that fundamental performance, look at the valuation, it's not expensive. And if this chart, you know, the wave 3 is off the chart here, but you know, if this holds muster, then I think there's plenty of upside in Meta. Okay, folks. Well, look, we've pretty much used up our time. I appreciate not being much of a chance to have questions. We had a lot to cover today, but in the last few minutes, if anyone has any questions, points, comments, anything at all, then now's a great time. So either shout into the system on audio, or use the chat room if you have access to it, or use the question function here in the webinar platform. So anything to cover before we finish off, folks? Okay, well, in that case, we'll call it a day. We'll post the recording in a couple of hours once it's compiled. Any questions that come up afterwards, obviously feel free to reach out in YouTube comments or chat room. Okay, someone said I like the coverage of Amazon. Okay, well, look, we can include Amazon. We do the work, so we might as well add it to coverage. The reason that we don't cover it formally is I don't feel like we have anything particularly innovative to say, if I'm honest. But we can certainly cover the fundamentals and the chart as we do. So sure, we can include that. We do the work anyway, so we can include that. Okay, thanks, folks. We'll see you all in chat later, and say recording posted in a couple of hours. Thanks a lot, and good night.